Hello, my name is Pete Harriman. Hopefully, you're here for the startup series, the financial projections portion. Um, I'm going to talk a little bit, introduce myself. That'll give us enough time for any stragglers to come in, but I want to respect those who are on time and get this party started. Okay. So today we're going to talk about financial projections, especially from a startup perspective. Um, The purpose of the presentation is to show you how to come up with projections. It is not to get into the nitty-gritty of projections necessarily. So this is going to be like the 300,000 foot view of projections and what they are. It is part of a startup series, so there were a few other portions of the startup series on how to get into business. So if you missed those are on YouTube. This is being recorded, so please be aware of that. You'll be put on mute when you come in. At the end, we'll probably have a Q&A session that you can unmute yourself. And of course, if you have questions, feel free to put them in the chat. I'm going to put something in right now. I think Aaron already did. So if you're new to Zoom, on the bottom, you should see some kind of blinking. That's how you can get to the chat and put a question in. As I said, we should have some Q&A at the end as well. If there is a very specific question that pertains mostly just to you, that's okay. That's great. But maybe you want to email me, and right here is my email, peter.harriman@maine.edu. So feel free to email me if it's a more specific, more in-depth question. Otherwise, feel free to throw it in chat, especially if it's a general question, because if you have it, more than likely someone else also has it. But by the end of this presentation, my hope is that you'll have some methods and some ideas on how to better come up with projections for your business, especially from the startup point of view. Now, as I said, we're going to go through a brief introduction of who I am, why I'm talking today. We're going to talk about what projections are in case, just to make sure we're all on the same page. We're also going to talk mostly about projections for new businesses, right? Startups. We're going to go through a formula type system that you can use. We're going to go through an example. And then we are going to have just two brief slides on if you're an existing business, how do you do projections going forward, right? Then we'll have wrap up and questions. And again, chat for any questions as we go, and they kind of get put in a queue and we'll get to them. But so who am I? My name is Peter Harriman. I work for the Maine Small Business Development Center. I've been here since 2015, so I've been here for quite a while. I work with an excellent team of advisors. We cover the entire state of Maine. We provide no cost or prepaid confidential business advising services. We've been doing it for a while. And as I said, we are located throughout Maine. So if there is a place that you want to meet in person, for instance, there's a reasonable drive to get to an office. Right? We are hosted across the state by USM, Northern Maine Development, and AvCog. That's how we cover the entire state. We have partnerships. Now, our super secret sauce is that we really do good at one-on-one advising. So yes, we put on webinars like this to help educate you, but the one-on-one advising is where you really get the benefit of the SBDC. It's a human you talk to, not AI. And you're going to be able to have a back and forth on questions and ideas and brainstorming. We have access to research of SBDC Net and Vertical IQ. We can help you with industry standards. And we're generalists. We're prepared for anyone that comes in the door for any kind of question. If we can't answer your question, it might be a referral to a resource that can. So no wrong door to come in here. Okay. That being said, we're not lawyers, we're not accountants. So during our talk, there might be times where I say, this is what I see in the 10 years I've been doing this, but you're going to want to talk to a lawyer about that. Or you're going to want to talk to your accountant. That's fine. Just know that. Now, if you want advising, that one-on-one advising, go to our website and right in the top right corner, there's a request advising button. Just click that, you fill out a form, and you're going to get in touch with one of our advisors. We also record these webinars. We put them on YouTube and we have playlists. So they're broken down by category. So you can certainly peruse the other categories that we have. Oftentimes your questions can be answered just by looking at those. And if you don't want to miss one, you can always subscribe to our channel and make sure that you get notified whenever one comes out, YouTube comes out. But you didn't come here to hear about this. You came for projections. So on with the show. Okay. So ultimately, projections are a best guess, right? People get really antsy, nervous, kind of, ugh, it's a best guess. But it's not just a best guess. It's a best educated guess. It's a best logical guess. It's a best reasonable guess. But it's still a guess, right? So as a business owner, you have to get comfortable with the fact that no matter how much research you're going to be able to do, it's still going to be a guess. Nothing guarantees it is still going to work. But we want to take as much guesswork out of projections as possible, right? Because getting to the point where it doesn't feel like a guess, there's no way around it, takes research. Research, research, research. There's tools like the SBDC. We'll get to some other resources in a few slides. But you're going to have to do some research. And we're not talking put it into ChatGPT and it pumps something out. That's not research. That's someone doing it for you. You, the business owner, should be doing the research. Okay? Projections are not about perfection, right? If you're a perfectionist, you might have a hard time with projections because it's a guess and you're trying to estimate, right? They're about logic and evidence. They're a way to tell your story of what you're hoping to do with your business. And the projections, the financial projections, tie directly in with a business plan. Whether you're getting money from a bank or not, you have a written business plan and you have financial projections, and they both are telling a story and they need to tell the same story, right? So your financial projections are just as important as those written business plan. So they need to tell the same story. And it's a way for you to understand what is going to go forward, right? What your assumptions are. It's a way for you to predict the future, right? So with proper projections, you can understand, is this going to work? Or it can be your canary in the gold mine, right? It could be, oh, hold on a second. I thought this would work, but maybe it doesn't. Or maybe it doesn't work at this price, or maybe I have to increase my marketing or have to get more people in or whatnot. But it's your way to understand, how should I position myself going forward? And should I spend my time and money going forward? So projections are definitely your first stop in the startup phase to understand what to expect, right? Now, so what are projections, just to make sure that we're all on the same page? Projections are financial statements, right? They usually cover 1 year broken down by month, and then there's usually 2 additional years broken down by year, right? And that gives you a good enough scan of the future that you can adapt, right? So it's 3 years total, right? And typically the format that projections follow are something called an income statement or a profit and loss, right? Where profits are listed first, expenses are second. So think of it as your best foot forward or your best impression first, and then your expenses last, right? So to kind of translate that a little more, your business, if you think of your business as a car, right? Your income statement or profit and loss is like how efficient your car is driving. It's the miles per gallon that you're going to get. Your cash flow statement, which is another statement that in your projections you're going to be creating, is like how much is in the gas tank, right? And these two work together, because if you have no gas in the gas tank, it doesn't matter how many miles per gallon you're going to get. You're not going to go anywhere. If you get negative miles per gallon, if you're really inefficient at your business, you're going to go through all your gas really quickly. So when we're looking at projections, we're focusing on mostly those, but projections can also cover a balance sheet, which is like, what is my car worth? Right. And there's other information that, especially if you're going to a lender, you're going to want to know, or if you're just starting the business, right? How much is it going to cost me to start? When do I break even? What's my debt service coverage, especially if I'm taking out debt? Um, but today, for these projections, we're really just looking at these two statements. Again, we're not going to get too much in the nitty gritty. This is a 300,000 foot view, but we're really concerned with how the business is going to run and how the cash flow is going to be, right? So this is the very simple formula that I came up with to help ensure that your business is successful. It's really, let's just walk through each one of these. I'm just kidding. Okay. So the formula, we have, I broke it down into three different sections, right? First, in the section you're going to spend the most time on is the bottom up or operational forecasting, right? And we'll get to what each one of these is. Then you look at the top down forecasting, right? The market share. And then finally, you look at what's called comparative or benchmark forecasting, right? And you're not doing one of these alone. I often see that when I get business plans to review, they just look at one of these, usually the bottom up. But we're going to go through all of them. And really, when you're doing your projections, you should look at all of them. They all have a different reason for being, right? Now, to help you remember this, that there are three different steps, I like to say, when you're looking to start a business or anything really, you have to look up, down, and all around. Okay, so bottom up, top down, all around. Let's get to it. So bottom up, operational forecasting, looking up from the bottom. This is where you build your projections, starting with the drivers of your business, right? So you don't think about the total, the end game, like, hey, I want to make $1 million. You're actually sitting there and you're gonna build it up block by block. So you want to answer the question, how does my business make money? And then conversely, the question of how does my business spend money? Right? And again, we're going to build this up block by block. So this is going to include how you make revenue, your capacity, your pricing, fixed costs, variable costs, and let's break that down a little more. So when people come into me and they say, I need to do projections for my business, I say, well, how does your business make money? And sometimes I get people who are like, well, I have 200 products that I'm going to sell, right? Or I'm a restaurant and I have a menu that's 3 pages long. Well, it's a little overwhelming to try to explain each combination that you might be selling. So think of your how you make money as a menu or products, but keep it simple, right? How would you present your pricing to let someone understand? And I'll have some examples here. So, for instance, if you're operating a business where the hours that you're open a day or week matter, so let's say you're thinking about your capacity, let's say you're a therapist, how many clients are you going to see a day, right? And or do the reverse. How many hours do you want to work? Let's say I only want to work 40 hours with clients. Then you can back up and try to figure out how many hours does that mean, or how many clients does that mean, right? So you're kind of breaking it down into a piece by piece where you're trying to think of what is the typical day going to consist of. Or if I'm a dog walker, how many dogs can I walk a day? And I kind of map out my day, and then I can think of it throughout the week and throughout the month. Or a restaurant, how many tables do I have? What is the average turn for the restaurant? And remember, I'm thinking of two numbers. What is typical and what's my max, right? I want to know what my max is because I want to know what my full capacity would be because that tells me when I need to maybe think about growing, or it tells me this is the top number my projections could possibly get to. Okay, so we're really breaking it down. Let's take it from a different angle. Let's say you group items and services. So a restaurant, people come in, they're going to order lunch and or dinner, and you can group that. What's the average spend? What's the ticket price for a lunch or a dinner? There's a billion different combinations they could have in a menu, right? When they order. But that's going to just blow your brain up when you're doing projections. So we don't want to do that. We don't want to do that to anyone reading the projections either. So what we want to do is break it down so it's simple. A contractor, price per square foot. What's the average size of your projects? A retailer, what's the typical customer spend, right? We're trying to get down to the nitty gritty of, okay, what does a typical day in the life look like? And with that, there's some ways that you can get more information, right? There's other ways you can get what's called primary data sources. So you can shop a competitor. You can go to a competitor if you have a physical location, go during different times, different days of the week. You can note the customer count. You can note their menu. How are they presenting their prices? When you're looking at people shopping, what are they picking out? What's their average ticket going to be? What's their marketing look like, right? A competitor can tell you a lot about that general area that you're going to be competing businesses in. Maybe they're looking at different marketing group, and you're going to target a different group. Or you can find people who aren't competitors in your direct service market, but outside your market. And you can reach out to them and say, hey, I'd love to pick your brain on how your business is running. And because I'm thinking about running my same. Again, outside of the competitor market. And this is valuable information. So my hint, don't ask for this for free. Okay. I see a lot of people say this like, hey, I'd love for you to spend your time telling me what you've learned over 10 years for free. Think of something to offer them a coffee, offer to buy them dinner, offer something, right? But I've seen this work sometimes. So you can try that. What's the worst they say? No. There's also associations, there's groups, there's chambers of commerce. There's a little note about the groups. There's a lot of online groups. I found almost every industry has an online group of similar cohorts of people in your same position who throw out questions to each other all the time. I see it on Reddit. I see it on other things. The caution there is sometimes I see very, very wrong answers. So just be cautious of where the information is coming from, but you can throw out common things like what's the best point of sale system to use for a restaurant or other questions like that and get some good information. But again, it's a lot of research. You're not just standing here hoping that it comes to you. You're going to have to go to that point, right? Other free resources that you can tap into, there's like a population count. So oftentimes understanding how many people live or work around you is very important. So this there's a website at the bottom there, so you can do a ring study. So like in Maine, I wouldn't use 1, 3, and 5 for the miles. I'd probably use 3, 5, and 10, and your study will come out something like this, right? This is my office in Portland. This tells me how many people live around me, how many households, what their income is. And with this information, I can use other resources to really get into what I think the customers are like in my area. Or traffic counts, another free website, right? That you can tell how many cars drive by. So again, I put in my address here, it popped up my address, and it gave me the average annualized daily traffic, right? That's the number that we're looking for. And that's basically, on average, 9,307 cars will drive down this point of the road. Now, keep in mind, cars go both ways, so I divide that by two. But if you ever wondered, those two little lines that you drive across, bump bump, that's the Maine Department of Transportation keeping traffic counts on most any road in Maine. The busier roads will have more recent traffic counts, and the more local roads might only do that once every 5 years or so. But that's another resource that would tell you how busy is my location going to be as far as traffic, right? But ultimately, as I said, these are just a few resources. There's a bunch of resources. I could go on and on and on about different resources that you might have available to you, but it's going to take research, research, research. And other resources other than the SBDC, there's SCORE, a very great resource there. There's the Women's Business Center, public libraries. As I said, if you get overwhelmed with the amount of resources, that's natural, right? It's in everyone's best interest for a business to succeed. So there's a lot of resources to help give you information. If you come to the SBDC, we can help point out other resources. So don't feel bad if we have to refer you. But the point is just to come in and get some help. So let's go through an example of that bottom down so we understand a little better on how to put this together, right? So how many days are you open a month? 26. I'm just going to say there's one day that I'm closed a week, right? So 26 in a month. How many visitors per day? 80 is typical. 200 is the max. Like 200 in a day is the max that is going to go through this particular business that I made up, right? Now, here's an interesting note. How many convert to paying customers, right? Because we have some like online stores might have traffic to a website, or retail stores might have people that come in, and this has become common. They come in, they find the product on Amazon as they're checking it out in your store, and they decide, hey, it's going to be cheaper to order on Amazon, and they leave. So we want to really be careful of just traffic counts, and we want to make sure we're talking about who is actually paying, right? So let's say out of the 80 people that come in, typically 75% or 60 customers typically are the ones that pay, right? Now, typical customers are about $25. That's what their receipt typically is. I decided to put this by receipt, right? But I even went even further for this example. And I said, okay, out of my shoppers, 35% of them are kind of light, and they're only going to have like $15 worth of receipts. And 20% of them are heavy shoppers. They're going to do about $50. So when you're looking at sales is probably a little too broad. So if you can break it down into different categories, lunch, dinner, um, high, medium, small, right? If you can break it down into different categories and understand those categories and how people are going to buy, that can help you kind of fine tune what you think your expenses are going to be. It might fine tune what your income is going to be, right? So try to do that. But again, we're looking for the Goldilocks, not too broad, not too detailed, but enough to get us actionable information. So taking this information, I can do the math, right? And I won't do the math for you, but I can do the math and I can say, hey, based on the typical light and heavy clients that I think are going to be in a typical day, my monthly total sales, again, I'm not doing expenses right now, but my total sales are 41,340. Right. So I just kind of went through and I figured out 41,340 is what I typically would make. Again, you do all that research to try to figure out what typical means. Each industry is different, and that's where talking to an SBDC advisor might help, because each industry, while there are templates out there, I find each one has to be customized for your particular business. Now, after we get to that point, I see this magic kind of sales line happen. Okay, so bear with me. I often see after we get to that 41,300 or and change, I see projections that look like this. Just, oh yeah, from day one, I'm going to start at my typical and I'm just going to go up from there. Right? Well, there's some things wrong with this. Let's break it down. One, remember that maximum that we wanted to figure out, what is the maximum we can do, max capacity? Well, this red line is based on that maximum capacity we found. That red line is where we can't go over without some kind of operational change, right? And that operational change could be hiring more people or expanding your business or opening a second location or whatnot, right? But with this projection, we know already it's not right because it's going above that line, right? The second thing is we're not going to start at the typical day from day one. We're not going to start at $40,000 the very first day. We're going to have to build up. This is a new business. There's marketing. There's a reason there's marketing. No one knows your story. No one knows you're there, right? You can put up as many open signs. There's only 9,000 cars that go by, right? So this isn't necessarily your typical day. You're going to need to do some marketing and build it up. So when people are doing projections, I have them figure out the typical day, and then I have them back up and say, okay, how long do you think it's going to take you to build your business up to that typical day? And again, each industry is going to be a little different, right? But in this particular example, I thought 6 months, right? And again, that's where research comes in, and we're talking the SBDC comes in, or SCORE, or whoever. But let's say in June, that's where I think it's going to take me 6 months to get to that 40,000 typical day mark. Great. I know after 6 months of being open, I'm going to hit my typical day of sales that I just thought of. Great. Well, what do we do from here? Well, using just a typical growth of the industry, you might be able to project how the continuing months go on, right? You can annualize that growth rate. That growth rate is usually printed by associations or through industry reports that you can get. So you can say, okay, going forward after my typical day, this is how I think I'm going to grow in sales. And I have information to back it up. I have all this data, right? Now, what's a little harder is on the other side, right? The other side is, hey, how long is it going to take me to ramp up, and at what speed am I going to ramp up? And that, I will admit, is a little bit more of guesswork, right? And I know people hate when I say that, but it's going to be a ramp. It's not going to be a jump. So we do want to make sure that it goes up appropriately. So if we kind of ramp it up there, so now, okay, this projections are looking a little better, right? As far as they're not going above our max. We got, it's build up to the typical, and then we got a little bit more based on the growth of the industry. But there's something wrong. Still something wrong with this. In Maine, we have seasons, right? So we also have to keep in mind the seasonality of our business. So if I'm a business and I'm in boat sales, well, guess what? When I go into October, November, December, my sales are dropping, right? They're not going up no matter how much the growth of the industry is. Or conversely, if I'm in mitten sales, guess what? October, November, December sales are looking really good, right? Because people are getting colder and they're looking for mittens. So when you're looking at your projections and you're looking to graph them out, especially, you're going to have that max line that you want to keep in mind, that max capacity of whatever business that you are in. And that could be a bakery, that could be a restaurant, that could be a hotel, that could be, a retail store. There's going to be a max where you can't deal with any more clients, right? And so keep that max in line. Keep in mind that you're going to ramp up to a typical day, and then you're going to grow a little bit based on industry standards from there, right? And keep in mind the seasonality, right? Seasonality is a big thing. We want to make sure that we're getting the seasonality right. But now we're going to flip to the other side. How does your business spend money? And there was a cheat sheet. The IRS stopped creating this publication 535. There's a link to it. They stopped in 2022, but this used to be a glorious publication where if you read it, and it is a little hard to read, but if you read it, it went through just about every expense you can think of for a business and how to handle it. Another cheat that I got from one of my colleagues is use a tax form, right? There's a Schedule C or 1120S or whatever tax form. They have the different categories of what your expenses are. Sometimes they're a little too broad, but you want to be able to look at your expenses, and expenses generally break down into variable and fixed, right? Variable expenses directly tie to sales, so think packaging, ingredients, materials. Fixed expenses or operating expenses are rent, insurance, and utilities. So with variable expense, if I sell one or 100, my expense will be either one times or 100 times because it ramps up with how much I'm selling. With the fixed expenses, it doesn't matter if I sell one or 100, rent is going to be the same. The insurance is going to be the same. You could argue utilities would be different, but utilities are going to be the same, right? So I usually tell people focus on the variable first, right? As you're doing your business, what does it cost to make that widget? What does it cost to have that person serviced if you're a service-based business, right? Is there a cost? But what is that variable cost? Because we want to understand that first, because that's going to be flexible based on how our projections are. And we're going to tie that in. Usually it's tied in as a percentage, right? So with a restaurant, we call it cost of goods sold. A restaurant, maybe the food cost, right? So every person that orders food, that's going to increase. The more food we get ordered, the more we're going to do it. So there's a cost of goods sold. There's an average for the industry. It could be anywhere from 28 to 40%, right? Depending on the ingredients that you're using, the type of food. So, um, so with variable, that you want to understand that because we're going to have to do a percentage in our projections to match what our sales are doing. With the fixed, well, with the fixed, there's other things we can do, right? We can break down each expense. So wages, for instance, that could be based on hours of operation. So it could be variable if you're paying people per job. Or what I like to tell people to do is create an employee work schedule for the week and fill it in, right? Especially with restaurants. How many servers? How many waiters? What do you need? How do you cover all the hours that you're going to be open, keeping in mind that someone can only work 40 hours a week? right? Or you don't want to pay overtime, right? And that usually, once you block off what an employee schedule might look like, that's going to give you a better idea of what wages you might be paying. Or the utilities. Ask the landlord, what were the utilities? Or ask the current tenant if you're a new business moving in. What are the utilities that I can expect, right? Or the utility company itself might have the records as well for that space. Um, Insurance, get a quote from an insurance agent, right? Or if you don't have a place you're going to rent, you can draw up what your ideal space requirement would be, your square footage, and you can get a realtor to give you what the average price per square foot for rent might be in that area that you're looking. And that way you can put in kind of in your projections a placeholder for all these expenses, right? And that's what we're trying to do. We're trying to reduce the uncertainty of what we're experiencing. We're trying to reduce any blind guesses by building it up brick by brick. The revenue, building that revenue and building those expenses, right? Piece by piece. There's no easy way getting around it. It is research, right? So once we've built it up from the ground up, both the revenue and the expenses, then we can kind of check ourselves by moving to the top-down forecasting. So looking down from the top. So this is trying to determine your market demand and trying to figure out, are they in line with what we would expect that we just did with our bottom up, right? And this is where we get into TAM, the total addressable market, SAM, the serviceable addressable or available market. We're going to get to each of these. Or SOM, the serviceable obtainable market, right? These are very common terms in the business world, but you might be encountering them for the first time. So let me break it down. Okay, TAM. It's Thanksgiving, guys, so pumpkin pie is on my mind. So TAM, the total addressable market, that's the entire demand for your product or service in the broad market. Think of no constraints, but think of what makes sense for your market. So if I'm a bakery in Portland, my total market wouldn't necessarily be the US. That's a little too broad. It wouldn't really be Maine because I'm not planning to sell to Presque Isle. Sorry, guys. But it would be the greater Portland area, right? So I'm thinking of the market, and then SAM is like, what is the slice from that market that I will actually be able to market to, right? So hypothetically, I could get 100% of this slice, right? But in reality, there's other people also getting that slice. So what part of Greater Portland would I actually be servicing if I was sticking with Greater Portland, right? It's a portion of Greater Portland. That might be limited to drive time. It might be limited to walk time. You can do a lot of research on that because then we move into some serviceable, obtainable markets. So we had that slice of Portland that we think we could reach with our marketing that would come in, right? People drive maybe 20 minutes. The SOM is the bite of the pie. This is the actual piece of the pie that we think we're going to get, right? So again, don't worry about the terms necessarily. Just remember, we're taking a big pie, creating a slice, creating an even smaller slice. We're trying to break it down into even smaller portions so we get even more defined, right? We don't want to be too big. In this case, we want to be as small as we can get. How much are we going to win? Think of year one. Now, this next slide's ugly, but bear with me. So let's put some numbers to that, right? So TAM, that pie, right? We have a population, right? Again, if we do the US market, that's too big. It's too broad. I see a lot of business plans that do this. They say, oh, the US market for baked goods is 82.9 billion. Okay, how does that really come into the projections for my business that I'm talking about in Greater Portland, Maine? Right? I included it because maybe you're an online retailer and you're going to be selling to the world or the US. Then that makes sense. But in this case, it doesn't make sense. So if I look at Greater Portland, I break it down into people who live here. Remember, there's some websites for that. And visitors. There's a very strong tourist market that can tell us how many visitors come. And based on the Bureau of Labor Statistics, I know that an average household spends $500 a year on baked goods, right? So that's 16.5 million per for the area that I'm looking at. And I'm assuming out of the 12.3 million visitors to the Greater Portland area, that 10% spend about $7. So that's 8.5 million. Now, again, research, research, research. These numbers are out there. We just have to find them. Okay. Then I break it down. Remember, that's too big of a pie. So I got an idea, but I'm trying to break it down even more. So now I'm going to break it down to what part of that pie, that 16.5 plus 8.5, what part of that pie is actually something I can obtain. So I'm going to say the service area covers about half of that. So only 25 million. Okay. I think I might have done my math wrong there, but then we break it down to what is my piece of pie? What can I actually think that I'm going to look at, right? And this is a little cheat sheet. Again, we're recording this, so feel free to uh, look at this later. But basically, when we're looking at sum, we're looking at through time, right? You're going to hopefully grab more and more piece of the pie as time goes on. So we can see on the left side on the business stage, new entrants can be anywhere from 0.1 up to 2 or 3%, right? So if we were to put numbers to that, we'd say, okay, my research market, if there's 20 competitors in the market, everyone gets about 5% or 1.25 million. So what is 1% share or 2% share or 3% share in that? 250, 500, $750,000, right? That's if I was a new to the market trying to grab some of this pie. That's what I could imagine I might be able to grab in year one. Year two is more, year three is more, right? I can grow bigger, but year one especially, that's what I'm looking for my projections. So when I check that with the bottom up, right? In my bottom up, remember that maximum line that I had? Um, we're not thinking about that. We're thinking about that typical when we did the forecasting. When we did that forecasting, the sales, when you added them up, was about 400,000 for the year, right? We had the 40, June was $40,000. We had the ramp up, we had the other side. So that magic line was about 400,000 for the year. We look at the top down model and we calculated that we're getting 1 to 2% market share. That's 250 to 500,000. That's right in line. See, that's all matching up now. That's saying, okay, my projections of 400,000 are within that 250 to 500,000 that I would think that I would do for the first year. So the bottom up model projections are within the expected limits of the top down model. So cool beans, that matches up. That's making me feel good about my projections, right? Then we go to the third and final stage. What is the comparative benchmark forecasting, right? So this is the look all around model. So when you're going to a bank, especially, the bank's probably going to pull up what's called RMA, Risk Management Association benchmarks, right? These are basically when people do taxes, companies grab that information in aggregate, not your personal information, but they grab in aggregate, and they can tell in the industry, hey, this is what to expect for a profit margin, or this is what to expect for cost of goods sold, or this is what to expect for rent payments or marketing budget, right? Based on the performance of all these people in your industry. So these benchmarks and ratios can be very helpful to do a final check to say, hey, am I in line with what I thought? So an example, I can pull an industry report from a data source called Vertical IQ. And in that data source, I can see that for a bakery, the pre-tax net profit is 6.13%. And the model is including 35 very small, so under 5 million in sales businesses, because I don't want to really compare it to a really big business, right? I only want to compare it to the smaller businesses. So I know, hey, my net profit's 6.13. So then I compare that with my own financial projections, right? And this is just telling a story. This is just kind of the guide bars. It doesn't mean I have to meet 6.13 for my net profit. It just means if I'm below or above that, how can I support why? Right? If I'm below, is there an expense? Is there something going on that I should check into? If I'm above, is there some reason that I think I'm going to do better than the industry average? And there could be explanations for that, right? I'm not saying that you have to change it to what the industry averages, but this gives us a good idea of what to expect. So if I was doing a bakery and I had a profit margin of 30%, I might second guess what my numbers were, right? Because the average in the industry is 6.13. So how am I so much better than everyone else in the industry? And conversely, like I said, maybe my profit margin is 2%. And I'm going to say, well, what's going on? Because everyone else in the industry is making 3 times more than me. So I'm going to double check what my expenses and inputs are just to make sure this is something I want to get into because it seems like something's off in my model, right? So the last benchmark forecasting does help to kind of step back and look at it in general. Now, you can also work backwards, right? So this is kind of fun too. So if you know the average net profit is 6.13% and you're hoping to make $100,000 after all expenses are paid and done, right? So sometimes people are like, well, I know I want to make this. Well, let's work backwards. If we know the profit margin on average and we know how much you want to make after everything's said and done, we know we can do the math. You will need to make $1.631 million in sales to if you're going to be within the industry average, right? So we can do it both ways. So remember, projections are your look into the future. We're trying to understand, is this going to work for what I want it to work, right? And as much information as we can get is what we're going to do to base our decision on, right? So typically, you're going to find many standard ratios in those reports that the SBDC score, all these different resources can get you this information, right? And then we can help you understand what that information means. So how these formulas work together, right? We have the bottom up. It builds a detailed operational assessments or assumptions from one after the other. It's a daily or a monthly forecast, so it's very nitty gritty. The top down tests against that market size and demand. It confirms you're not overreaching for your market. And that look all around, the comparative model validates that realism of what your ratios and results are, right? It adds that external credibility to it. All three methods in the formula should agree and should be working together. If one doesn't agree, it's not the end of the story, but you should have some reasoning or strong assumptions as to why is it isn't fitting within one of the models that we have, right? Now, what happens if you're an existing business? Because I said I'd help out the existing businesses too, right? Well, you have history and you have context, right? And ideally, 3 years of history to make you not a new business, right? But let's say you had 3 years. What I would do to start out for the projections, I would start with my history. This is what I've done over the last 3 years. Now, why do we look at 3 years? Is because sometimes you have up years, sometimes you have down years. This will spread out that and make it an average, right? But not only that, I'm going to want to do what's called common size these. I'm going to put them into common size percentages. So that means I'm going to take the sales and make the sales 100% and then break down all the different expenses and profit by a percentage of sales. Now, why do I do that? It's because it means I can really look easily at all 3 years and figure out any kind of patterns, right? So for instance, when I look at this, there's a lot of different numbers and I'm thinking, oh man, COGS went from 100 to 130 to 110. That's quite a variable. But if I look at the percentage, it's all 40. In fact, when I look, whenever there was a low profit year, it's because my wages got out of hand. Went up to 48 or 55 versus the best year I had, it was down to 40. So this helps me understand a little bit more about my business anyway, which isn't a bad thing, but it's going to help me in my projections forward to say, okay, if I want this to work better, I really need to understand how I've been doing in the past, right? Because once you get these 3 years, you want to take that average of the 3 years, right? And that average is going to tell you, hey, when I balance out for the up years and the down years, I should make, if I'm running it like normal, about 283,331, right? But that 3 year is just a guide bar for that first year projection, right? Because maybe you're expanding. Maybe you're going to do a bigger marketing push. Maybe you're going to have some kind of adjustment to what you're doing that's going to change it. But that 3 years gives you that guide bar for both your sales and your expenses to understand, hey, this is what's typical if I typically run the business like normal. And then I would go through and change it. Okay, I think my sales are going to increase by this. I think my wages are going to be higher, my rent's going to be higher, right? And then you can kind of go through that. But at least that 3 years of history gives you that context to do it. And then you can use the top-down method and the comparative benchmark methods to make sure that you're in line still. But as far as your bottom up, you've already got that. You've already built that, right? And you just need that history to make sure you do it. Remember, it's a guide bar. It's telling a story. You need to make sure you tell your story, right? Now, some common pitfalls that I see, and there's a lot of them here. Don't get discouraged, right? But the endless summer, right? That seasonality question, don't have an endless summer, right? There's very few businesses that have an endless summer. So you want to make sure that you're adjusting for seasonality in your projections. You underprice your product or service, right? And we didn't get anything into pricing because I have another webinar that you can watch if you want called Pricing, Pricing, Pricing that goes all into how to price, right? But I see it all the time. People underprice their product or service and then they get into trouble. You understaff your business, right? Remember that projection line? I often see like year two, it's going up and up and up and up and up and up and up, but their staff remains the same. And I'm like, well, geez, what is it? Do more with less? So you want to make sure that as your projections go up, not just your staffing, but all your other expenses are probably going to creep up as well. So keep that in mind. Um, Not researching your cost appropriately, right? Or missing a cost. That's again where sometimes working with SBDC, SCORE, Women's Business Center can help you out to make sure you're not blindsided by a common expense of the industry. Not narrowing that pie down, right? Remember, we started with the whole pie, and that's where I find a lot of businesses focus on is that whole pie. And I'm like, no, it's too big. It's too big. You can't eat the whole pie. You might be able to eat the whole pie, but I wouldn't eat the whole pie. You want to get it down to a slice, and then what is your bite of the slice? That's really what we're trying to get down to. What is the most reasonable explanation of how much of a market we're going to get, right? Ignoring the ramp up time, right? Remember how in the magic line we started at 40 at the beginning? Well, that's not gonna realistically, that's probably not gonna happen. Your typical day is not gonna happen out of the bat. If it does, I'm very happy for you. But we want to make sure, part of being doing projections is to plan. And prudent planning would tell us that it's going to ramp up to that typical day. It's not going to start out as a typical day. Underestimating time for renovations or construction. I see this a lot where they think it's going to take a month and then they'll be in business. But then 3 months later, the contractors are finally cleaning up. So don't underestimate that time if you do have renovations or construction in your projections as well. Not looking at research that does not support your assumptions. When you're doing research, it's very tempting to always find research that tells you you've got a great idea, right? I love doing that. Like, oh yeah, look, I'm so smart. This agrees with me. But when you're doing research, you really have to also look for anything that's saying, hey, this is not a good idea, right? Because each industry has risk in it. So for restaurants, because we're focusing on bakeries, the cost of ingredients has gone up. The cost of eggs have gone up, right? The cost of labor has gone up. So all of that has meant a lower profit margin. And my research would bring that up. And then I'd say, oh, ooh, do I really want to get into that business right now? Not outlining your assumptions or thoughts, right? So as you put this down, your numbers on the projections, it makes perfect sense to you because you've thought of them, right? But when you look at it maybe a month later, you're going to look at this and say, what was I thinking? I have no idea. Or if you give this to a bank, they're going to say, I don't understand where you got this, right? So you really, really want to always state your assumptions, right? You should always strive to know where they came from. Examples, projected sales are based on 10% market share, or sales are higher due to competitive advantage, or sales are higher than the 3-year average due to a 20% increase in the marketing budget in a new campaign, right? But always put down where those numbers came from so either you can follow them later or someone else can follow them, right? But if you don't remember, because I don't remember after a month, right? If you don't remember how you got to that number, it doesn't mean anything, right? So you got to make sure you remember how you got to that number and if it made sense, right? So other than death and taxes, there are two things I know to be true about business. It's going to cost more and take longer than you think, right? This is not to discourage you. Again, all projections are all about planning and making sure that we're prepared, right? Because we're all prepared for a business to be hard, but we want to make sure it's not surprisingly hard, right? So we're trying to get that surprise out of it. So it is time to recap, okay? Understand what answers you are trying to get when you're doing projections, right? Is your question, do I want to do this business at all? Is that the answer you want? Do I want to make a certain amount of money? Is that the answer you want? So what are the answers you're trying to get? Do the research. There's no short, I know AI's come in and it's come a long way. There's no shortcuts. Do the research. It'll help you in the long run, trust me. Look up, look down, look all around. There's 3 steps to this, okay? So don't shortchange. Try to do all 3 to make sure your projections, your bottom-up projections are tying into your top-down projections, which are tying into the benchmark projections. Use context if you have it. So for those businesses that have been in business, use that to your advantage, right? Remember, projections are your best educated, logical, reasonable guess. Okay. All right. Questions. Do we have questions? I think we do.
We do.
Okay. What, we have a recap of any of them?
Yeah,
Oh,
I
we
can
have
go
an AI
back to the
assistant
first
on.
one. I
I should
think
have
it
badmouthed
relates,
AI
but I'm
so
not
much.
sure. What percentage of your gross should be going to payroll?
That, I mean, that's, as I said, the hard part of putting this slide deck together was covering so many different businesses. So what percentage should be going to payroll is pretty industry specific, right? And even in the industry, there's still ranges, right? Food businesses has a high wages. If you're a drop shipper, you might have low wages because someone else is doing all the work, right? You don't have a lot of laborers. So that would be for if you're really looking at, hey, what can it do? I would say get in touch with me with the email. I can pull up a vertical IQ report, which is on your industry, and that can give us the breakdown of what the typical business would spend on wages and salaries, right? But that unfortunately is kind of a more broad question based on the industry, right? So sorry I have to bunt that, but that's too specific. There's no magic formula as far as what that should be for every business. Uh,
You ready for the next one?
yep.
Are these sites available by state? I live in New Jersey. I think this was related to the Maine dot.
Oh, yeah. So the like the ring study site that I did,
Yeah.
that's anywhere. The main DOT site that does the traffic survey, I'm guaranteeing most states have a similar type of survey because most of the time the DOT is keeping track of road traffic to make sure they're paving on the appropriate schedule, right? More frequent roads get paved more often, yada, yada, yada. So even if you're in New Jersey, Colorado, Alaska, there probably is some kind of road study that's being done that you can access because that's all public dollars being usually being done with it, unless it's a private road. So you should be able to access that whatever state you're in. It's just a matter of contacting the Department of Transportation and finding out where they have that information. I had a question come in, a direct question come in about inflationary rate. Great question, right? So as we do our projections, we're assuming things are going along smoothly. We got that year 2 and year 3 that we're thinking about. Well, is year 2 and 3, are the costs going to stay the same? No. As we know, inflation has reared its ugly head, especially in the last few years. But typically, when we look at inflation going forward, we typically want to factor in about 3 or 4% going forward. The inflation of 9% that we saw a year or two ago, that was extraordinary, right? And yes, that did affect a lot of people. Prices are a little whacked because they didn't expect it. It was higher than what they probably had for a price increase, but typically to kind of smooth it out into the average is about 3 or 4% from one year to the next, right? That we're going to do for that. And that almost doesn't matter the industry. Yes, some industries get hit by inflation a little harder, but I would say 3 to 4% for most of your costs, insurance, stuff like that. Um, there was
Next
one question
question.
about virtual services.
Yeah,
So if you're a
research sites for.
business that's online offering virtual services, so that's why in my market, I had that explanation about, hey, you could do the whole US technically, but it's too big for my particular business that I'm looking at right now. So if you're offering a virtual business that literally has no boundaries that could go, I will admit, coming up with reasonable projections is going to be hard because it's kind of a newer animal. So you don't have newer as in 20 years, but you don't have all as many good data points and resources that you can go to. So that's where a lot of groups come in as far as, hey, with my internet traffic. So if your virtual service is based on marketing and you're hoping people will come to your website and convert to a buying your service, then that comes down to what's the typical conversion rate of visitors to whatever. And then you can look at what is the typical ramp up if I do a certain marketing of how many visitors might visit me per per day, per month, or whatnot. And then you can try to build up, from the bottom up. You can try to build up, hey, how many clients do I think will actually get my service? I already know my pricing, so I can understand that. I know my max. And then I can try to build up the most logical, reasonable way to ramp that up. I hope that answered it. The online, I will admit, the online, because a lot of this focused on like a specific location that you could either go to or you could ask other people about, or people are coming in the door. That's a traditional model, right? So online services, online retail, that's a little more research. It's a little harder. Like if you sell through Amazon, it's a drop shipper. Well, how does that work? You can get there. It's just a lot more research because your market area has just gotten a lot bigger potentially, right? But costs are also there. Sorry, uh, how would I build projections from business where my revenue is tied to variable bookings and speaking fees instead of product sales? Build projection of my business where my revenue is tied to. So kind of like the cost of goods sold for a restaurant, right? So the number of clients that they see is going to be how much food expense they have. So with this one, if I'm reading it correctly, the number of speakings that you book will have a direct impact on what your expenses are. So, business speaking fees instead of product sales. So, I mean, your product is the speaking, right? So you'd have to understand how many speaking events you're going to book, right? And how many bookings you're going to have. That is your whether it's a physical product, and that's where again I tried to kind of cover as much as I could in this webinar, whether it's a physical product, an online product, or a service such as speaking, right? There's still the same method that you do. You kind of build it from the bottom up, saying, okay, how many speaking engagements can I do in a month realistically, right? And then we go out in the market and try to figure out with other speakers what are their schedules look like for a competitor analysis. Um, you just go through the three different methods. You can do it. It's a little specific. So certainly sign up with an advisor. We can try to pull out some information for you to help you with that research. Um, but like I said, whether it's a physical product or an online product um, or a service that you're doing, same kind of methodology to do the projections. How detailed do you need to be for service-based businesses with irregular monthly income? I mean, as I said, it's kind of like a Goldilocks, so it can't be too broad that it's just kind of glazing over a lot of assumptions. It can't be too nitty-gritty where you're getting kind of stuck in the mud on the details. So you're gonna try to find that Goldilocks. Um, oops, that's my timer. So I know that didn't answer too much of it, but you want projections that are going to give you the confidence to make the decision to go forward. That's kind of the best answer I can give you. If you don't have confidence in your projections because they're not detailed enough, then you shouldn't move forward. If you're getting bogged down in the projections because they're way too detailed and there's too many variables, then you might have to go a level up, right? But you are the one starting the business. You are the owner. You need to understand the projections and you need to be able to take action on those projections, right? So it doesn't help you any to try to shortchange projections or to take shortcuts. Right. Um, research sites. If you have a physical product, we got a lot of questions, and the timer was that we hit our time limit for a minute, or for an hour. Um, and coming up, focus on how to price your product service. When will that be? So the pricing. It will be coming up in January, I believe. Aaron can tell me better. Aaron, when is that
Yeah,
price?
January 12th, I think. It's up on the website, so you can sign up for that.
Yep. Pricing, and it'll go through your pricing. But we also remember we record these, so you can also attain that through the YouTube channel as well. Now, I know other people have also written questions in the chat where we're at the time, so I will stay on and answer the questions if you want to stay on. But I understand if you need to leave, that you can certainly leave the chat. But I'm going to keep going through questions if that's okay, Aaron.
That's fine.
Uh, and then, and again, if you have to leave, that's fine. My email's right here, peter.harriman@maine.edu. So please feel free to send me an email if you have that specific question or you have that request of, hey, I have an industry and I need to know what my particulars are for my industry. We can certainly look at that, right? And get you going. So I had, if you have a physical product that could be sold nationwide, but it's not attainable in the 3-year projection period, do we limit our TAM to Maine or New England for projections purposes since that's more real? Yes. Yes. So remember, your market can change with time, but we want to understand what is that slice of market so we can do that analysis of are my projections in line with what I'm actually going to do. So we don't want to have too large of a market if that's not actually what we're going to do. And I see this with people who are like, oh, I'm going to do Maine, then New England, then even further. Okay, well, when you're first starting, it's kind of like when you're playing baseball, right? You don't look at where it's going, you look at what's coming in right in front of you. So same thing, you're going to limit your research to, okay, this is the market. You can say in your business plan, you can say the overall market is this, and this is where we're trying to get to. But for plans, year 1 through 3, this is going to be our focus, and this is what we're going to get, and this is why this market cap that we're going to get makes sense with what the projections are that we're doing for these first few years. And then as you grow, that's going to change, right? Projections are not something you should do once. You should do projections. I would say every year you should do projections just to make sure you're, one, keeping it kind of fresh, and two, you're analyzing your numbers to help you do the projections. You're doing more research, right? So projections aren't just when you're first getting into business. Projections are an ongoing exercise that you would want to do to make sure that your business is going to succeed.